So how does the average investor do when it comes to their performance of their investments? Well, unfortunately, research shows that their results often lag the overall market. Primary factor in that is what we talked about in our very first chapter video for our book, Next Gen Dollars and Cents. The category or the topic in chapter 1 is all about human behavior. So this video, along with chapter 13 of our book, Next Gen Dollars and Cents, really looks at the average person's results through a series of charts and graphs that we'll attempt to explain here in the video, because charts and graphs lend themselves well when it comes to paper, but not as easily with the video. So we will attempt to explain the details of them as we go through this video. So many people, and understandably, follow the do-it-yourself approach because they use the various tools that are online, use 800 numbers, things like that. And the problem is that studies show that those online calculators are nothing really more than general guidelines that only represent 5% of the population. And as for the 1-800 number call centers, I don't know about you, but you may have spent some time on one of those. It's doubtful that by the time you actually get to a person that they have a whole lot of experience in guiding people as it relates to their money and their investments and their finances. So certainly those approaches provide more cost-effective alternatives for managing money and finances, but we strongly believe that personally tailored fiduciary-based guidance can really help you better weather the ups and downs of the market and life and help you to stay on track more effectively with your financial goals. Unfortunately, let's face it, the financial services industry does not have a particularly great track record for always providing advice that is in the customer's best interest. And so let's be honest. Anyone assisting with your finances should be a fiduciary with many years of experience. Certainly have been in the industry for a while to kind of see all of the types of things that you might encounter along the way. The average investor stymies their investment results in 3 distinct and much studied ways, which chapter 13 of our book, Next Gen Dollars and Cents, really kind of gets into. Beyond the notion of getting poor advice from the industry or relying on the internet or 1-800 numbers, there's 3 sort of distinct mistakes that investors make that we break down in that chapter 13 of our book. The first mistake has to deal with the fact that the average investor typically underperforms the stock market due to a lot of those behavioral biases and suboptimal investment strategies, if you will. Factors such as emotional decision-making, chasing the highest and best performing returns, or what your buddy told you about, lack of diversification, poor timing, those kinds of things all contribute to underperformance. And one of the graphs that we have in chapter 13 really kind of shows that, where the average investor missed out on about 30% of the overall market's annualized return if you look back over the course of the past 30 years. And that's certainly a huge difference, right? Considering the power of compound growth, you could wind up with less than half of what you should have. So really looking at the average performance of that fund investor versus the market, that average investor missed out on about 30% of the market's annualized return over the course of the past 30 years. That's a huge difference, right? If you compound that over a 30-year period of time, that means you're retiring with half as much money as you should. So that's mistake number one. Mistake number two is that history tells us, and this one is always one of those toughies, history tells us that some of the market's very best days are in fact clustered around some of the market's very worst days. And see, those very best days really help to repair a lot of the damage that can happen on one of those very bad days in the market. And so all it takes is to just miss time just a few of those days in the stock market that can significantly impact your investment returns. So once again, in the book, there's a little chart on this. Over a span of 20 years, just missing the 10 best days of the S&P 500 resulted in a 50% reduction. 50% reduction in your total return over that 20-year period of time. Stop and think about that. A 50% reduction for just missing 10 trading days out of the more than 5,000 trading days that occur within a 20-year period of time. Certainly some dramatic results when you start to parse through what, unfortunately, the average investor sees in terms of their return. So at Nelson Financial Planning, we believe that the single best strategy to help people avoid this is to make sure that they have good perspective and good education along the way. That's why we regularly send out electronic communications to our clients to help give them some perspective on what's going on in the overall markets. We think that that is very valuable, particularly when the overall media has a tendency to really emphasize the negative, and that causes people to really lose perspective. The third mistake that investors make on average is, and I guess maybe this is true of human behavior, is they have a tendency to put things off until later, right? We all have a kind of a tendency to do that, putting things off that we know we probably should do now, but we wait until a later time. Unfortunately, when it comes to procrastination and your money and your future, the results can be very costly. Waiting, or this process of waiting is certainly makes up the third big mistake that people make when it comes to shortchanging their investment returns over time. So when investing, you really can't underscore the notion of starting early and how significant of a difference that makes in your end results. Chapter 13 of our book sort of compares two different investors. Got one investor that starts saving $250 per month at age 22, but does that only for the first 10 years. Investor B then waits 10 years and then at age 32 starts saving that same $250 per month and actually continues to save that through the age of 65 for a total of 34 years. The bottom line on where these two investors are at the age of 65 is nothing short of shocking. Assuming a 10% return over that period of time, at age 65, investor A, the one that started 10 years early and then stopped and only did it for a 10-year period of time, accumulates over $1.3 million, while investor B only accrued about $810,000. What's worse is that investor B, even though they wound up with significantly 40% less money than investor A, they actually wound up contributing 3 times the amount of money over a much longer period of time than investor A did. That power of time and compounding is truly impressive, particularly when you look at things over the course of an extended period of time. Chapter 13 of our book concludes with a possible solution to procrastination. And the reality is that one of the biggest reasons why people procrastinate when it comes to investing their money is this notion of market volatility. Well, the reality is market volatility is a normal part of investing. But one of the best ways in which to sort of mitigate or offset the short-term market swings is to invest regularly. This concept known as sort of dollar cost averaging has a good track record of really helping to generate out good returns while smoothing out the ups and downs in the market. So how it works is you set a certain amount of money to invest each and every month, and then you do so each and every month. When the market's up, that amount of money buys fewer shares when the market's down, though that same amount of money will buy more shares. And as a result of that, then ultimately it does help to smooth out that overall volatility. So for more details on these 3 mistakes that the average investor makes, and more importantly, how you can avoid them, read chapter 13 of our book, Next Gen Dollars and Cents. You can get your free copy of our book by texting free copy to 407-791-0070. That's 407-791-0070. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, and author of Next Gen Dollars and Cents. Thanks so much for watching this video.